After starting this module, you shall be able to know what are the various problems associated with managing cash and what are the strategies for effective cash handling. This module will help you learn about the different motives of holding cash. This module will further help in identifying the objectives of cash management and understanding the factors determining cash needs. Further, this module will also help in identifying the approaches to obtain optimal cash balances, namely cash management models and preparation of cash budgets. Finally, you will be able to know what are the techniques of cash management.
Activities aimed at efficiently handling the inflow and outflow of cash. This mainly involves diverting cash from where it is to where it is needed. In other words, cash management is the optimization of cash flows, balances, and short-term investments. Cash in this context may refer either to cash in the form of currency or to other equivalents such as checks, drafts, deposits, among others. While organizations may hold other assets which can potentially be converted to cash, cash management essentially deals with the management of liquid cash and near cash assets such as marketable securities and time deposits, which can be readily converted into cash. The primary feature of such cash balance is that it has no earning power. Lack of control over cash flows and inefficient cash management can be very harmful to business. More often than not, it is the improper management of cash that has caused businesses to fail. Effective cash management is therefore a necessity for the businesses. Companies heavily rely on knowing their cash position to manage working capital requirements such as ordering inventory, raw material, or acquisition expansion program, for which they need a clear idea of how much cash is required and when. This is enabled by efficient cash management. Moreover, a company's cash position is said to be a better indicator of the health of its business rather than its profit and loss statement. Hence, knowing the cash position is crucial for every business to forecast when, how, and where cash needs may arise, determine which would be the best source for additional cash needs, and be prepared to meet cash needs when they arise. And for better visibility into the cash position across banks, across borders, cash management is crucial. It empowers businesses with the ability to forecast cash flows, plan future business strategies, and manage cash accordingly.
Cash and cash equivalents include coins, currency, checks, drafts, demand deposits, marketable securities, time deposits, and so on. There could be different motives behind holding cash. These can be transaction motive. Here, the motive of holding cash is to meet the basic cash requirement on a routine basis so as to meet the activities being carried out in ordinary course of business. For example, cash payments for employee salaries, wages, etc. Precautionary motive. Here, the motive of holding cash is to meet the uncertain or unexpected cash needs which may arise due to unanticipated factors like natural calamities, sudden increase in price of raw materials, etc. Speculative motive. In this case, cash is held in order to take up unforeseen opportunities which may suddenly crop up and turn them into their favor. For example, cash may be needed to make purchases at discounted prices which may be available for a specific short duration. compensative motive. Here, the cash is held in order to compensate banks for providing certain services like clearance of checks, payment of bills on time, etc. For this, a minimum balance may be needed to be maintained in the bank. The two basic objectives of cash management are: 1. To meet the cash disbursement needs. Second, to minimize funds committed to cash balances. Optimum cash balance needs to be maintained by firms, which is neither too high nor too low. If large funds are lying idle, firm is losing out the money and not earning anything. Cash needs to be effectively managed so that the cash payments can be made on time. This is advantageous for the business in the following ways: prevents insolvency or bankruptcy, good relationship with stakeholders, cash discount can be availed through timely payment, strong credit rating, favorable business opportunities, and meet unexpected cash expenditure. Factors determining cash needs are as follows. First, synchronization of cash flows. Cash balance needs to be maintained as cash receipts and cash payments occur at different times and in different amounts. If they reconcile at all times, the need for maintaining cash balance will be eliminated. Synchronization can be achieved by preparing a cash budget which will determine the time period when the firm has excess or shortage of cash. Second, short cost. In case there is a cash shortage, the firm may have to bear the burden of extra cost occurring due to the shortfall. Such costs include borrowing cost, transaction cost, loss of cash discounts, penalty cost, etc. Third, excess cash balance cost. If the firm has excess cash, then also it bears the cost in the form of opportunity loss to earn interest on the excess cash which could otherwise be invested elsewhere. Fourth, procurement needs. These are costs associated with establishing and operating cash management activities. Fifth, uncertainty. As the business operates in uncertainty, there are certain costs which crop up suddenly, like immediate demand by supplier to make the payment, sudden rise in prices of raw materials, etc.
Another aspect of cash management is knowing the optimal cash balance. There are a number of methods that try to determine the magical cash balance, which should be targeted so that costs are minimized and yet adequate liquidity exists to ensure bills are paid on time. One of the first steps in managing the cash balance is measuring liquidity. There are numerous ways to measure this, including cash to total assets ratio, current ratio, quick ratio, and net liquid balance. The higher the number generated by the liquidity measure, the greater the liquidity and vice versa. There is a trade-off, however, between liquidity and profitability that discourages firms from having excessive liquidity.
Let us now discuss the models of cash management. A number of mathematical models have been developed to determine the optimum cash balance. We will study two important models of cash management: Baumol model with certainty and the Miller or cash management model. Let us start with Baumol's model. It considers cash management similar to an inventory management problem. Following are the assumptions of this model. Cash needs of the firm are known with certainty. Opportunity cost of holding cash is known and remains constant. Transaction cost of converting securities into cash is known and remains constant. Suppose a firm starts with a cash balance of C rupees. When the firm spends cash, its cash balance starts decreasing and reaches zero. The firm again gets back its money by selling marketable securities. As the cash balance decreases gradually, the average cash balance will be C by 2 as shown in the figure. Opportunity cost is the interest foregone, that is, the income that the firm would have earned had it not sold out its marketable securities. Suppose the opportunity cost is given by I. Then, firm's holding cost for maintaining an average cash balance is I times the average cost. Whenever the firm converts its marketable securities to cash, it incurs a cost known as transaction cost. The total number of transactions in a particular year will be total funds required T divided by cash balance C, that is T by C. If the cost per transaction is B, then the total transaction cost will be given by a. Thus, the total annual cost can be worked out to be as.
In order to manage its cash balance, the company can employ a mathematical model, one of which is Miller-Orr model. The Miller-Orr model helps the company to meet its cash requirements at the lowest possible cost by placing upper and lower limits on cash balances. The operation of the model is as follows. A company should have its desired cash level, an upper limit and a lower limit on cash balances. When the cash balance reaches the upper limit, the company has too much cash. It then should use its cash to buy marketable securities in order to bring the cash balance back to its desired cash level. When the cash balance hits the lower limit, the company lacks cash. It then sells its marketable securities in a manner to bring the cash balance back to its desired cash level. If the cash balance lies between the upper and lower limits, there will be no transaction in marketable securities.
As the demand for cash C increases, the holding cost will also increase and the transaction cost will reduce because of a decline in the number of transactions. Thus, there is a relationship between the holding cost and the transaction cost. The optimum cash balance C star is obtained when the total cost is minimum. The model can be mathematically represented by the following equation, where C star denotes optimal conversion amount per transaction. Now, let us move on to the next model, that is Miller-Orr model. As per this model, effective cash management helps to determine the optimal cash balance level, which will minimize the cost of cash management. Further, this model assumes that the cash balances randomly fluctuate between an upper bound and a lower bound. The model sets higher and lower control limits H and O respectively, and a target cash balance Z. When the cash balance reaches H, let us now understand one of the most effective tools of cash management, cash budget. It is a statement showing the estimated cash inflows and cash outflows during the planning period. It thus highlights the net cash position, surplus or deficit of the firm in a particular planning period undertaken.
A cash budget is a statement showing the estimated cash inflows and outflows over the planning horizon. Companies can prepare a cash budget on a quarterly, monthly, weekly, or even daily basis. The ultimate purpose is to identify the net cash position of the company in the future, that is, whether there is any cash surplus or deficit. Preparation of a cash budget is an indication of good planning. If such a budget is not prepared, the company runs the risk that if unfortunately it is in a sudden need of cash, there may be insufficient time for company to search for alternative source of financing, forcing it to accept funding which is more expensive. After identifying the net cash position of the company in the future, the next question is then how the company manages the cash surplus or deficit. The cash budget contains an itemization of the projected sources and uses of cash in a future period. This budget is used to ascertain whether company operations and other activities will provide a sufficient amount of cash to meet projected cash requirements. If not, then the management must find additional funding sources. The input to cash budget comes from several other budgets. The results of the cash budget are also used in financing budget, which itemizes investments, debt, and both interest income and interest expense. The cash budget is comprised of two main areas, which are sources of cash and uses of cash. The sources of cash section contains the beginning cash balance as well as cash receipts from cash sales, accounts receivables collections, the sale of assets, etc. The uses of cash section contains all planned cash expenditures which comes from the direct materials budget, direct labor budget, manufacturing overhead budget, and selling and administrative expense budget. It may also contain line items for fixed asset purchases and dividends to shareholders. If there are any unusually large cash balances indicated in the cash budget, these balances are dealt with in the financing budget where suitable investments are indicated for them. Similarly, if there are any negative balances in the cash budget, the financing budget indicates the timing and the amount of any debt or equity needed to offset these balances.
Cash budget is useful for the following reasons. First, it helps in coordinating the timings of the cash needs. Second, the firm can identify the timing when there is surplus or deficit in cash balance and plan accordingly to invest or borrow. Third, if the cash budget shows sufficient cash, firm can take the advantage of cash discounts and thus reduce its cost. Fourth, it is also useful to ensure all payments are being made on time. Fifth, favorable business opportunities can be taken up with proper planning. Sixth, the accumulation of excess funds lying idle can be avoided and the same can be invested to earn return on them. Let us now understand the various steps for preparing the cost budget. Step 1. Selection of planning period. The first step to prepare the cash budget is to identify the period for which the cash budget is to be prepared. The planning period differs from firm to firm. It should neither be too long nor too short. The budget can be prepared on an yearly, quarterly, monthly, weekly, daily, or seasonal basis depending on the circumstances of the case. Step 2. Selection of factors affecting the cash flows. The next step is to identify and select factors of the cash flow. Only cash items are to be included. Generally, two types of cash flows can be there. Operating cash flows, which are generated by operations of the firm, and financial cash flows, which are generated by financial activities of the firm. Operating cash flows examples: cash sales, purchases, salary payments, accounts receivable, accounts payable, etc. Financial cash flows examples: loans, borrowings, income tax payments, refunds, interest received, paid, dividends received or paid, etc. Step 3. Construction of cash budget. The final step after deciding the planning period and identifying the operating and financial cash flows is the construction of the cash budget. Let us now identify the techniques of cash management. Cash management techniques can be divided into two broad heads: speedy collection of receivables and slowing disbursements. The various techniques for speedy collection of receivables are as follows. Speedy cash collections. Customers should be encouraged to pay as early as possible. This can be done by offering cash discounts if they pay early. Early conversions of payments into cash. There may be a lag time as to when the check is prepared and when it is converted into cash. This time needs to be minimized. Concentration banking. This is a collection of procedure in which payments are dispersed to collection centers and then deposited in local banks for quick clearing. Lockbox system. This is a collection procedure in which payers send their payments to nearby post office lockbox. The local banks collect the payments from this lockbox several times during the year and deposit it in the firm's accounts. The other sets of techniques for slowing disbursements are as follows. Avoidance of early payments. Firm should make the payment as late as possible but before the due date to avoid any penalty and interest charges. Centralized disbursements. The payments should be routed through the head office. This will delay the payments and cash can be reserved for several other reasons. Float. This refers to the difference in bank balance and book balance of the checkbook. This arises because there is a time gap between when the check is written and when it is encashed. Accruals. These are current liabilities for a good or service received but not yet paid. For example, payroll to employees, rent to be paid, taxes to government, etc. The longer the period after which the payment is made, greater is the amount of cash with the firm, which can be used elsewhere. Let us summarize what we have learnt in this module. In this module, we have learned about the meaning of cash and cash equivalents, motives of holding cash, objectives of cash management, factors determining cash needs. Further, in this module, we have understood cash management models, namely Baumol's model and Miller-Orr model. We have also discussed the steps of preparation of cash budget. Finally, at the end, we have discussed the techniques of cash management.
Cash refers to the currency and cash equivalents like checks, drafts, demand deposits, marketable securities, time deposits, and so on. Motives of holding cash can be transaction motive, precautionary motive, speculative motive, or compensating motive. The two main objectives of cash management are to meet the cash disbursement needs and to minimize the funds committed to cash balance. The factors determining the cash needs are synchronization of cash flows, short cash, excess cash balance, procurement needs, and uncertainty. Cash management models are Baumol's model and Miller-Orr model. The aim of these models is to identify the optimum level of cash balances to reach the objective of effective cash management. Cash budget, one of the most important tools of cash management, helps to identify the net cash position of a firm. That is, whether the firm has surplus or deficit cash. Based on that, the management works to manage it effectively. Other techniques for cash management are speedy collection of cash receivables and slowing the disbursements. Cash is important to every organization. It is crucial for companies to hold cash for payments, but at the same time avoid holding excess cash, as this is a non earning asset. Cash management is therefore a balance between liquidity and profitability. Companies are strongly advised to prepare a cash budget to highlight the net cash position in the future and devise its cash management strategies with reference to Miller-Orr model. Students are reminded that cash management is a concept within working capital management. The proper management of cash is part of various working capital management methods such as factoring accounts receivables at banks to get immediate cash and offering discounts to customers to encourage early collection. Students therefore need to think broadly and link various concepts together in order to provide a better solution in the examination.